Hey everyone, thanks for joining me for this one. In today's video, I'm going to be talking about 7 stocks that I bought in the stock market over the last week. I'm also going to be going through how my overall portfolio did in the last week. As a spoiler alert, it did not do well, so we're just going to jump into that first. And if you like this kind of content, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. So as you can see, my Canadian account here was down over $5,500 in the last week alone, lost 4% of the value in my Canadian account. USD account here, a bit smaller of an account, but still down 1,800 US dollars or 3%. Collectively in Canadian dollars, probably lost about $8,000 on the week just in this portfolio. So a really terrible week. If we look at the broader market here, you can see TSX went down 3.5% this week. As I just look out over the last year, you can see that's probably one of the worst weeks. Looks like it was a bad week here. As I look at that, there was a bad week here, but probably one of the top 5 worst weeks in the last year. So really poor week in the market today, or this week rather. Look at some of the other indexes here. Nasdaq here, past 5 days down 3.5% as well. S&P 500 largest companies in the US for the most part down a bit less, 3%, but still overall pretty tough week for the market. So going into some of the stocks I bought, obviously when the market goes down, if you have stocks that you want to own for the long term or that you don't think have been fundamentally impacted by whatever's impacting the markets, in this case it was interest rates and fear for higher rates for longer, then it could actually be a great buying opportunity for certain positions, certain stocks. So that's what I tried to do this week, find the stocks in my portfolio that weren't really impacted to a great degree, or in some cases they are impacted, but I thought that the impact of the difference in valuation from the stock going down was well worth it to jump in. So the first stock that I was buying up this week was Jameson Wellness. This is one that I was buying last week as well, but I really upped my position here, probably doubled it in the last week to 70 shares. Currently trading at around $25 a share. This one's gotten clobbered over the last year. We're down about 25%. If we're just to look at Jameson Wellness a bit more here, you can see they're a business that's on track to do about $670 to $690 million of revenue. The growth rate's a bit misleading just because of the amount of time this year that they had their U.S. acquisition. You can see here that there lots of growth, about half the growth, half of this growth rate is purely from U-Theory, which was an acquisition they did in the U.S. But even without that, still growing about 10% on top line. And this is a $700 million business, currently trading at a market cap of just over $1 billion. In terms of EPS, going to do about $1.60 in EPS, trading at $25. So they're trading right at like 15, 16 times earnings here. So pretty good valuation, in my opinion, versus lots of the other CPG companies out there. And even though this has been a bit of a slowdown year on EPS growth, you can see it's going to be flattish, a couple percent growth. Over the long term, this company's done a really, really great job of growing EPS 10%, 15% plus. In most cases, EPS even ahead of revenue as they strive for scale and efficiency. So there may be some FX things going on, maybe some integration costs going on. Long term, I do believe that they'll get their margins back in check, and that'll be a huge tailwind for the valuation and for the stock. Going into another reason I do like this stock, they recently made an acquisition into the US. So Jameson's mostly a Canadian brand. Then they have a division in China, which they're really expanding fast on. And then Europe, they distribute to, but it's less of a focus. It's more just a distribution model to other wholesalers. But they recently made a bigger push into the US with the acquisition of U-Theory. And this is great for a couple reasons. First of all, I think it's a great brand. It seems like a great brand. They give some of the information here if you want to pause and read it. And then just looking at their products on Amazon here, they have tons of products. You can see it's super premium vitamins, essentially, they're selling here. Ashwagandha, $18. Fat burning, just kind of go through these. As you can see, vitamins, different types of benefits, testosterone boosters, immunity, collagen, stuff like that. So lots of great products, great benefit spaces that they play in. But in addition to that, this also unlocks the potential future for Jameson to make their way in the US, which is a huge market, obviously, compared to Canada's market there. So I think this is a great business. I think they'll continue to grow into the long term as they have in the past in all of these segments, or the important segments here. So I think for a 15, 16, even 17 times price to earnings, given the rate that they've grown their earnings over time, I think this is a good stock in my opinion, and it's one that I'll likely continue to buy week over week. Currently have a dividend yield here of about 2.8% on this one. And they've increased their dividend year over year since going public, rather. Okay, stock number 2 that I have been buying in my account this week. This one I actually added in my TFSA account, A&W Royalty Income Fund. Added 40 shares in my TFSA. So this one, and just royalty funds in general, down 3% this week on A&W, and I just do not believe that royalty funds are impacted too much by interest rate increases, other than alternative options for yield, right? Because lots of people buy these for yield. So if the treasuries or GICs you can get higher yields on, maybe that gives an alternative investment opportunity. But generally speaking, higher costs of doing business don't really flow over into royalty corps because they're just taking a percentage of revenue. And if anything, as costs go up, so do prices, and then you're getting a percentage of a higher price base. So I think these are relatively safe from inflation, generally speaking. There's always exceptions and nuances and indirect impacts, obviously. But in addition to that, A&W operates in like a quick service space where even if the economy does go down, which it does look like that may be happening a bit here, they should still be good. If anything, lots of people trading down into quick service restaurants from sit-down restaurants. So I do think that the valuation or the defensiveness of this business is a pro, not a con in times like this. Currently paying 5.9% dividend yield. They've done a great job of growing same-store sales growth over the years. You can see here they've really experienced a rut, not because their earnings are down. Their earnings have actually been up and their royalty payments up year over year over year. But this is really just multiple contraction, where they used to be trading at 20 to 25 times. Now they're trading at 15 times. So that's fine with me. I don't really care what the stock's trading at. I care about their fundamental growth over the last 5 years, which we've seen, yet the stock price has gone down 9%. So this is one that I have been buying as well. And then in the same breath, I added a few shares of Diversified Royalty Corp as well here. 272 price, you see in the last week, down 2%. Exact same sentiment as A&W. I think lots of their businesses aren't really too badly hurt in recessionary times. You have businesses like Mr. Lube and whatnot that even if people or if people aren't going out and buying new cars, I think it's a higher chance they're getting their cars fixed. They're having issues with parts and stuff, and those people will be going to businesses like Mr. Lube. This one pays an even juicier dividend at 8.7%. So getting really strong monthly cash flow from these royalty corps here. Don't have any debt on their balance sheet or direct exposure to debt as well, which is great, especially in an interest-raising environment. So I like these companies. I think I'm comfortable with them making up a good chunk of my dividend portfolio here, and I've been adding to them throughout the week. Going into the other stocks that I have been buying this week, moving into the U.S. side of my portfolio, I've been buying a lot of U.S. stocks. The first one that I have been buying here is S&P Global. So S&P Global is a stock that I used to only own 3 or 4 shares of. Now I own 7. So I've pretty much doubled my position this week. Similar to Jameson, this is one that I'm open to building into a bigger position. I think they have a great credit business. Their credit business is pretty much just a duopoly between them and Moody's. If you just take a look here for some background on their credit business. So they operate or they rate credit in 137 different countries. 100% of the top 50 institutions reference S&P Global ratings in terms of how S&P rate their bonds as they go to market and try to sell debt or different types of securities to investors. And I've said it a few times before, but I truly do believe that no matter what happens in the economy, even if the economy goes down, more companies may be looking to raise debt. Just like during the pandemic, lots of companies had cash flow problems, needed to go to the public markets to raise debt. All of that debt that they needed to raise would have had to get rated by Moody's and or S&P Global in order for anyone to touch it from an institutional investor point of view. So that's a really strong recurring um, revenue stream and business model to be in, given how challenging it is to build credibility and equity in this space. It's really hard for another agency just to open up next year and compete with S&P and Moody's on a grand scale after everyone already talks about ratings in the sense of S&P ratings or Moody's ratings, and why wouldn't you go with one of those two if that's what everyone knows and everyone's comfortable referencing and kind of putting as their stamp of approval on these types of debt deals. So looking at the company over the last 5 years, they've done really well, up 77%. It's dipped a couple percent this week. So we're down 5% this week, which I thought was a great opportunity to start nibbling it a bit more because this is definitely an expensive one. Looking at their PE, I think their PE trailing, they must have had some tax or some one-off situation, but their future PE is around 28 at these levels, I believe. Dividend yield approaching 1%, and they increase their dividend yield every year. So it reminds me of Visa, really small starting yield, but when you're getting 10, 20% increases year over year, I can live with a very small starting yield for the name, especially if they're creating a lot of value from their share price and growing their intrinsic value of the company as well from how much money they're bringing in. The next stock that I've been buying this week, and this is one that I acknowledge is definitely impacted by interest rates, but I thought it was getting to a really enticing valuation. So I have been buying Realty Income Corp. You see it down another 6% this week, but even just in the last month, this one's down 10% on the month behind the sentiment of interest rates staying higher for longer. Looking at the dividend yield here, we're getting almost a 6% starting yield here. The company pays a dividend every month, and they actually increase their dividend quite frequently. You see here at the bottom, this month they actually increased the dividend slightly. It was only about 0.5%, but they steadily increase that dividend yield year over year and usually quarter over quarter. So even if it's just 0.5% here, 0.75% there, it really does add up and compound over time in terms of how much you're getting paid out. I now own 171 shares. I think last week I owned 160 shares, so have been buying a good chunk of shares here throughout the week. Couple here, couple there. Still down pretty bad, down 14%, but I am getting that nice dividend yield every month at least. Looking at their estimated funds from operation, they're expected to do just about $4 here of funds from operation in this calendar year. So if I go back to their share price, $4 means that at $52, they'd be trading at 13 times funds from operation. So we're just under 13 times funds from operation at the current valuation of the company. Given their exposure to every single state, lots of different property types, all triple net lease, they're really vast assortment of tenant exposure, so it's not really one industry that can take them down. I think they're really well positioned to weather a storm. I think in these environments that interest rates stay higher for longer, smaller real estate companies may get hit a lot harder, not be able to keep up, get forced with higher interest rates, not enough collateral. But a $40 billion company, one of the biggest and best managed retail companies in the world in terms of real estate, I think if anything, they'll benefit from this over the long term as they have better buying opportunities. The cost of holding real estate for big corporations goes up. Maybe they want to just do sale leasebacks with companies like Realty Income at more attractive valuations than they'd historically be willing to do. So I'm kind of looking at the long game here, thinking in 10, 20 years from now, do I want to own the best triple net real estate company in America? The answer is yes, and I think it'll be worth more than it is now. And between then and now, I'll be getting my almost 6% starting yield that'll go up year over year. So that's why I bought more of Realty Income in my portfolio this week. And if it keeps going down closer to 50, under 50, it's probably one that I wouldn't mind continuing to average down on since I have that higher cost base on it for starters here. Okay, going into the next stock that I was buying this week. The next stock that I was buying this week was just a little nibble on TKO Group. So TKO Group was a stock that just interests me. I wanted to follow it. They are the combined merger of the WWE Worldwide Wrestling Entertainment with the UFC, the Ultimate Fighting Championship that was spun out by Endeavor. If you look at this company here, they had a huge drop in the price here. So they went from 100 all the way down to 85. We'll talk about what happened there in a minute. But I'd say that I actually bought this stock at the very beginning or at the early part of the week for around $100, and then I got the opportunity to sell out of it at around $104. I'm not even seeing that register on the chart here, but it was a point that it got to $104. I just had 3 or 4 shares, so I said whatever, I'll sell this, and I ended up buying a share of S&P Global with it. And I'm so lucky that I did, or else my terrible week would be about $70 even worse, because the day after I sold out, the stock price went down to $85. So when it went down to $85, I decided to pick up a couple more shares. So I'm in it for 3 shares right now, just $250, average price of $85. The reason that the stock price tumbled to this extent was really around their deal with their deal on SmackDown. So I'm just trying to find the rights agreement here. So they finally signed a 5-year agreement starting next year with NBC Universal, taking away the rights from Fox starting next year. And it just seemed to be some concern that the raise that they got on the rights went from $1 billion over 5 years to $1.4 billion. I think lots of investors thought they were going to get an even bigger raise, as they were quoting how live sports were doubling in value and stuff like that. They got a nice 40% raise, but it's not 100% or 200% that some of the big sports leagues ended up getting. The other thing is reliance on cable, and it seemed like I'm not a cable expert, but it seemed like the NBC Universal package or channel that this will be on was maybe thought of a bit less, or had a bit less households, or was declining more with linear cable than where the current production was going to on Fox. So a couple concerns there on viewership, on the total amount, and the fact that the other franchises that WWE owns, whether it's Monday Night Raw or some of their other businesses, the media rights also come due next year. So in addition to this deal maybe being a bit less than investor expectations, it kind of lowers the expectations for those other deals as well. Another interesting thing here is TKO is announcing, or has announced, a special dividend. It's actually a pretty big one. So $4 a share will get paid out to shareholders who own the company as of close today, which the market just closed. So I'll be getting that, payable next week. So on the current stock price, that's pretty much like a 4.5% dividend yield that I'll be getting as a one-time payout next week. I'm sure the stock price will probably just go down on Monday, that $4. So it's probably going to just be a wash. But thought that was interesting that they're doing that to provide some liquidation for their shareholders. That was an interesting build there. And then just for those of you who may not be familiar with the overall company, this is kind of the landscape between the UFC, the WWE. The UFC here is expected to do about $600 million in EBITDA. WWE last year did about $400 million. So collectively, they do about $1 billion in EBITDA. In addition to that, though, the UFC had a big amount of debt here. So they had $2.7 billion in debt. You kind of see it here on the chart. It's maturing in 2026. So they need to start paying off that debt slowly, or they need to refinance that debt, which I'm sure they will do at some point. But that's a really big chunk of debt for a company that's doing $1 billion in EBITDA a year to overcome in a few years. Transparently, I don't think it's possible for them to do. They're going to have to take out more debt later down the line, smooth out their debt chart. And that debt may come at a higher rate given where interest rates have gone. I think that's another reason why the stock has kind of trended down over the last week since it went public with that interest rate news as well. Okay, the last stock that I was buying this week was VXUS. Another boring one, but this one is the Global International Equity um, Stock ETF, excluding the United States. Sorry, choked on that one a little bit, but you can see here over the last month, this one was down about 3%. So this owns stocks and equities from every country around the world, all over Europe, Japan, Australia, China, even Canada, Latin America, but it doesn't own any American stocks. And I thought that was fine just because I already have tons of exposure to the US throughout my account. You can see here now I'm up to 35 shares. I added probably 15 shares throughout the week, which was a pretty sizable amount. Currently down a little bit as the market trended down this week, but this is one that I'd love to build out into a much bigger position just to feel really good about the global exposure of the equities that I'm exposed to. So this is one that I'm going to keep nibbling on a little bit every single week until it gets to a very sizable position within my portfolio here. One thing that's great about this one, I've talked about it before, but the yield 3.1%, so getting a pretty good starting yield out of the name as well. So this is one that I would probably have bought even if the stock market went up because I'm just dollar cost averaging into this one over time. So honestly, don't mind that it was down 3% on the week, got in, saved a couple bucks on the shares that I was buying this week. So that pretty much covers it in terms of the stocks that I was buying this week. Was adding those 7 stocks, lots of other interesting stocks out there. Coca-Cola I had my eye on throughout the week, but I really did add most of this or all of this last week, so thought I was still in a good position. But that's one, if it slides into the mid 50s, I may have a close eye on in the week ahead. And there are a couple other ones in terms of REITs and other things that just have gotten into really, really interesting value territories that I'll be evaluating in the week ahead. CN one of my favorite stocks, also had a really tough week, down about 5% here. So that one I always have an eye on. They're always buying back their own shares as well. So I don't mind when it goes down because I'm just getting a better deal on those shares that the company's buying for me. And yeah, it's lots of interesting opportunities out there in the market depending on what your view of what's going to happen with the macro economy, what's going to happen with interest rates, strength of the consumer, that you can make bets and investments behind. But overall, I'm trying to not let kind of the noise get in the way of the stocks I'm investing in and my long-term hypothesis and what I'm trying to achieve long-term with dividend income in the portfolio, and just take these tough weeks as a bit of a opportunity to average down, get better deals on stocks that have fundamentally not changed in my opinion. So if you like this kind of content, thanks so much for watching. Please make sure to give the video a big thumbs up. Would also really appreciate it if you made it to the end of the video. If you let me know in the comments as well. Love to hear from you guys. And if you haven't yet, consider subscribing to the channel. Thanks so much for watching, and I'll see you in the next one.